Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Big Lots stock by analyzing its financial statements and dissecting its financial ratios, so we can determine if it's a buy or a sell. Big Lots is a retailer headquartered in Columbus, Ohio. It has 1,400 stores in 47 states. It's a discount chain that sells furniture, home furnishings, seasonal items, toys, and much more. Let's get started with the model. This is a small cap company, 1.7 billion market cap. They're trading at $46 a share, and there's 37 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has positive free cash flow in 3 to 4 years. Net income is the profit and loss on the income statement. It's revenue minus expenses, and they have positive net income every year. Revenue is the sales for the company. That's really consistent. They haven't grown too much the past 4 years. This is the company's income statement. The top line is the revenue, the sales for the company. Below that is the cost of revenue. The expenses directly related to generating the revenue, and that's about 3.1 to 3.2 billion every year, and their gross profit is about 2.1 billion every year. So the numbers are really consistent. Operating expenses are around $1.9 billion a year, and their operating income was the lowest in 2020, 156 million. They do have a bit of debt, so they paid 16 million of interest on their debt, and then they have a big amount in other expenses. This was due to the gain on a sale of property, plant, and equipment. So their pre-tax revenue was the highest in the 4 years, even though their operating income was the lowest, due to this gain in other income. And they do have positive and pretty healthy net income every year. And this is the statement of cash flows. The top line is the operating cash flow, how much money the company generates through its regular operational business. Then you have capital expenditures. These are investments in property, plant, and equipment. And then the difference between those two numbers is their free cash flow. That's the cash that's left over after running your business. And that was $74 million in 2020. It was negative in 2019 because they had a big capital expenditure year. They do issue quite a bit of debt, 44 million in 2017, 109 million in 2018, and 303 million in 2019. 2020 looks really good. They didn't issue any debt and they paid down 73 million. It looks like they've been issuing the debt mainly to pay down the capital stock. They paid down 254 million, 165 million, 111 million, and 55 million. Let's take a closer look at operating cash flow because I think that's the heart of any business, their operations. And the way you calculate operating cash flow, you start with net income, that was 242 million, and then you have to adjust for the non-cash items on the income statement. They had that big gain on PP&E, so they have to reverse it out on operating cash flow because that's not part of their operating business. Their business is to sell products through their retail store, not to sell machinery and equipment that they use to run their business. They have to also add back depreciation of $135 million because they booked that as an expense. They have deferred taxes. They booked as an expense of 52 million. They have to add that back. And there's other non-cash items. So the company has pretty healthy operating cash flow each year. That's what you want to see when you invest in a business. Let's look at a capital structure. $845 million of equity, 1.5 billion of debt. So they are a bit leveraged. Their net debt is also 1.5 billion. And their WACC is 8.14%, which is a blend of the cost of equity and cost of debt. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 2.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3 billion. We divide that by 37 million shares. And we get a calculated stock price of $80. They're trading at $46, so they're trading at a 43% discount. It's a strong buy according to the model. Simply Wall Street is even higher than me. They're at $100, so they're saying the stock is even more undervalued. This is the stock price the last 5 years, and it was steady for a couple years, then started to dip for about a year or two straight. But once coronavirus came, this stock went way up. Their store sales have been doing really well during COVID. So you can see the company has been raising its dividend over the past few years. It was 19 cents, then it went up to 21 cents, 25 cents, and it's been at 30 cents for a couple of years. They pay a 2.6% dividend yield. Their payout ratio is 18%. Payout ratio is annual dividends over net income. If you invested $10,000 into this company 10 years ago and you reinvested the dividends, you'd have $19,400 today. If you did not reinvest the dividends, you'd have $18,500 today. Their trading volume is pretty low, only 1.4 million in the past 3 months. They have 37 million shares outstanding and all of them are on float. And over 100% are held by institutions. This must include options and warrants and things like that. That's why it's over 100%. And almost 30% of the shares are shorted, so investors are pretty bearish on this stock. The company has a really high beta, 2.49, so the stock moves 2.5 times the market. It's pretty volatile. The stock is up 57% in the past 52 weeks, much higher than the S&P of 14%, and their 52-week range was between $10 and $57. And the stock is trading between its 200-day moving average and 50-day moving average, so it's in an uptrend. Once the 50-day moving average touches the 200-day moving average, that's called the golden cross. So past the golden cross. If the 50-day does fall below the 200-day average, that's called the death cross. So the market is bullish on this stock, even though there are a lot of short sellers out there thinking the stock is overvalued. Big Lots started in 1967 under the name Consolidated Stores. It opened its first location called Odd Lots. The drugstore chain Revco acquired Odd Lot Trading. That's a different company. So eventually Consolidated Stores changed its name to Big Lots. In '94, Consolidated acquired Toy Liquidators, adding 82 stores in 38 states. Consolidated also purchased KB Toys in 1996. In '97, they purchased Pick and Save for $995 million in stock. In 2000, they sold KB Toys and Toy Liquidators. In 2005, the company closed 170 stores. In 2011, the company purchased Liquidation World. This is a Canadian closeout retailer with 89 locations. It was a pretty inexpensive acquisition, only $20 million in cash, and they had to assume some debt. This is the first time Big Lots has ventured out of the United States. But Big Lots eventually closed the Canadian stores in 2014, citing poor sales. The company reported third quarter revenue of this year up 18% to $1.4 billion. COVID is really helping this company because lots of people are staying home and going to this discount retailer to furnish their homes. At the end of 2015, the company had 1,449 stores open. It's been closing little by little every year, so they're down to 1,404 in 2019. These are a list of all their stores. They have 151 in Cali, 105 in Florida, 112 in Texas, and 44 other states. This is a list of their sales. Furniture is their largest. It was $1.2 billion in 2017, then grew to $1.3 billion, then $1.4 billion. But their total sales are pretty steady year to year. But 2020, they're going to have a huge year in terms of revenue. The average age of its leadership team is 53 years, and the average tenure is 1.3 years. The CEO has only been with the company a little over 2 years, and the compensation package is $6.5 million. BlackRock owns 15% of the company, Vanguard 12%, then Dimensional Fund, FMR, LSV, State Street, and McKellum. This company trades on the New York Stock Exchange, the Deutsche Börse in Germany, and the London Stock Exchange. Let's look at the financial ratios. The average PE is 12, the median is 14.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 7.0, so that means investors are paying $7 for $1 of earnings, much better than the median and average. Price to sales is stock price over sales per share. They're at 0.3, so they have an amazing price to sales ratio. Price to book is stock price over book value per share. They also have a really good price to book ratio. Great price multiples. And to calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet. They have $845 million of equity. Their tangible equity is also $845 million. So it looks like they don't have any intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They're at 9.3, so they can easily cover their interest payments. ROE is net income over equity. They're at 29%, much higher than the median and average. Current ratio is current assets over current liabilities, so they can cover their current liabilities with their current assets. Their current assets are $52 million of cash. Most of it is in inventory, $921 million. And the company seems to be well capitalized. Their free cash flow was $74 million, and their working capital is $193 million. The best way to look at ratios to compare them to similar companies, I've done videos on Costco, Dollar General, and Walmart, all in the same industry as Big Lots. And if Big Lots has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in PE, price to sales and price to book. They're a little better in current ratio, a little better in ROE. They do have more debt than the average company, and they're by far the smallest company of the group. But they do pay the highest dividend of all the companies. So to summarize, it seems like this company is doing really well this year and probably will do really well next year. I'm not sure after that, but in the short term, it looks like a really good stock. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.